Council resumes the second reading debate on the Inland Revenue Amendment Minimum Tax for Multinational Enterprises Groups Bill 2024. The chairman will speak and give a report on the Bills Committee. Mr. Ronick Chen, please. President, I submit the report in my capacity as chairman of the Bills Committee on the Inland Revenue Amendment Minimum Tax for Multinational Enterprises Groups Bill 2024. The bill seeks to implement the OECD's International Tax Reform Framework BEPS 2.0 to impose a global minimum tax rate of 15% on multinational enterprises groups or MNE groups with annual consolidated revenue of 750 million euros in at least 2 of the 4 fiscal years immediately preceding the current fiscal year. The bill seeks also to introduce the Hong Kong minimum top-up tax. The Bills Committee held 2 meetings and invited written submissions from the public. Members in general support the bill to fulfill Hong Kong's international obligation to tackle cross-border tax evasion and safeguard Hong Kong's taxing rights. Members are concerned about the impact of the implementation of the global minimum tax and the HKMTT on Hong Kong's tax revenue. Members asked the administration about the criteria for calculating the expected tax revenue. It's expected that the implementation of the proposed tax regime will bring to the government an additional tax revenue of about $15 billion per year from 2027 to 28 onwards. The administration said that the IRD has in the past few years required MNE groups with annual consolidated revenue of 750 million euros to submit annual country-by-country reports to the IRD, setting out details of their revenues, tax expenses, and so on. The additional tax revenue of $15 billion per annum is IRD's preliminary estimate based on the information in the country-by-country report and the minimum tax rate of 15% to be charged. The administration added that a country-by-country report only reflects the annual consolidated revenue of an MNE group amounting to 750 million euros in the preceding fiscal year, as MNE groups may make structural adjustments in response to these new tax measures, which may affect their tax expenses, coupled with IRD's lack of detailed information on each of the Hong Kong constituent entities of these MNE groups. The additional tax revenue of $15 billion per year is only a very rough estimate. Given the different tax incentives provided by the government to facilitate the development of specific industries by attracting overseas enterprises to Hong Kong, members and the legal advisor to the Bills Committee asked whether the implementation of the GLOBE rules would adversely affect the benefits of MNE groups brought by the concessionary tax treatments under the IRO. The benefits include, for example, tax concession for aircraft leasing, concession for qualifying aircraft leasing manager, and concessionary tax treatment in respect of certain income derived from intellectual property. The administration explained that while some in-scope MNE groups may pay lower tax as a result of the tax concession arrangement, whether the group is liable to top-up tax depends on whether the effective tax rate of the group in the jurisdiction of Hong Kong is less than 15%. Regarding the tax incentives that have been introduced in Hong Kong, the administration pointed out that they are applicable to businesses operating in Hong Kong in accordance with the OECD's minimum standard. That is, the tax incentives concerned should not be granted to local enterprises only, while other foreign enterprises are subject to higher taxes. Some members pointed out that Hong Kong has all along been practicing a simple and low tax regime and a territorial source principle, whereby foreign income is generally exempted from profits tax under Part 4 of the IRO, and there is no capital gains tax and dividend tax in Hong Kong. However, with the implementation of the global minimum tax and the HKMTT in Hong Kong, the in-scope MNE groups may be required to pay top-up tax on the relevant income and profits. Members have asked how the administration will continue to publicize Hong Kong's tax advantages in order to attract more enterprises to set up their operations in Hong Kong. The administration explained that Hong Kong will implement the global minimum tax and the HKMTT to comply with the latest international tax standards, and the measures are not targeted at offshore income or capital gains. Hong Kong will not impose Part 4 profits tax on capital gains. Hong Kong, therefore, will not introduce new tax types. On tax competitiveness, the administration said more than 140 jurisdictions worldwide agreed to participate in the BEPS 2.0 framework. Hong Kong, together with other jurisdictions, will need to implement the global minimum tax in a way that's consistent with the target outcomes of the globe model, as well as administrative guidelines published by the OECD. As such, the simple and low tax regime that Hong Kong maintains remains competitive compared to other jurisdictions. In addition, jurisdictions that used to compete for business and enterprises with low or zero tax rates will no longer be able to use their tax policies to attract enterprises. Moreover, with the unique advantages of the one country, two systems principle, coupled with our excellent infrastructure, pool of talents, and our status as an international financial center, Hong Kong's competitive edges will be even more prominent. The Bills Committee deliberated on the taxation mechanism, the proposed new offences, and the commencement date. In the light of the views and suggestions made by members and deputations, as well as the administrative guidelines promulgated by the OECD after the Gazette of the Bill, the administration will propose CSAs to the bill. The Bills Committee has no objection to these CSAs and will not propose any CSAs to the bill. The Bills Committee has completed the scrutiny of the bill. The details are set out in the report to this Council. President, the following is my personal views on the bill. I have to first declare that I work for a financial organization which is considered as an in-scope M&E group under the amendment bill. Tax revenue is an important source of income for the government. Tax revenue can ensure even distribution of resources and provide better business environment for enterprises. The government has the obligation to, based on the changes in our society, adjust our tax policies. M&E groups, they are in many jurisdictions, and there are different tax policies in different jurisdictions. Enterprises, they need to make profits, and they go for low tax jurisdictions, and therefore different jurisdictions, they are lowering their profits tax, and this bad competition will restrict tax revenue. There are 130 jurisdictions that have currently accepted the OECD proposal. I very much support the SAR government to implement the BEPS framework. And taking into account our local conditions, we should adjust our tax to increase tax revenue. And we should not lose out to the others because of not implementing the proposal. 2 years out of the 4 fiscal years preceding the immediate current fiscal year, M&E groups that reach the threshold of 750 million euros of profits or revenue, they have to pay the top-up tax, and this does not apply to most of the SMEs. We are adopting most of the provisions proposed by the OECD, and so during the discussion we focus on the details of the implementation of the tax proposal. I'm glad that the government took on board some of the views made by the professional bodies as well as members of the committee. This is to reduce the compliance burden of the enterprises, and the discussion helped dispel a lot of concerns. And on the questions raised by members, the administration helped address a lot of these questions, and I appreciate the patience. Low tax regime has been an appeal for a lot of enterprises. The government has rolled out a lot of tax concessions covering aviation, insurance, and other sectors since year 2000. This council has scrutinized 59 bills related to tax. A lot of these bills have to do with reducing corporate profits tax. For example, in year 2019, there was an amendment bill that's to do with the tax concessions for the insurance sector. In year 2023, there was also a bill that has to do with the tax concession for aircraft leasing. After the implementation of these amendment bills, jurisdictions can no longer rely on their low tax regime to attract enterprises. In the US, the rate is 21%, in the UK is 19%, and in Japan is 23.2%, Singapore is 17%. 16.5% of profits tax in Hong Kong is still very competitive around the world. Also, For 6 years in a row, the SAR government has rolled out tax concessions. Also, we've been implementing the transparent two-tiered tax regime. I believe that with the BEPS framework, we can still show our advantages. Also, to support specific industries, the SAR government has rolled out tax concessions, and this is in line with the international tax reform and principle, so no adverse impacts would be caused to the relevant enterprises as well. Also, investment entities as well as insurance investment entities are not included as the in-scope M&E groups. The latest statistics show that in year 2024, there are 9,960 enterprises with parent entities in Hong Kong. They mainly from the US and Japan, compared to 9,039 in 2023 and 8,900 some in year 2022. We see an increase in the number of these enterprises over the past 3 years. These enterprises are not only attracted by our low tax regime, but also our legal system, our status as a free entrepôt, free flow of information, as well as huge business opportunities from the mainland. These are all our competitive edges. Surveys also show that 12% of the enterprises have plans to expand their operations and businesses in Hong Kong in the coming 3 years. This shows that enterprises often take into account a series of factors, and tax is not their only consideration. We need a comprehensive set of policies in order to create a good business environment. In year 2024, there are 360,000 SMEs in Hong Kong, accounting for over 98% of the business entities in Hong Kong. They are the major force in Hong Kong. They will continue to enjoy the tax concession for profits tax. They can also benefit from the 74 subsidy schemes rolled out by the SAR government. While the tax regime proposed may have impact on M&E groups, we can still attract SMEs to operate their businesses in Hong Kong. Market stability, economic stability, infrastructure, as well as labor force and our culture, they all have to do with our business environment. Traditionally speaking, we have enjoyed a free and open market. We have a good legal system, and we are an international financial center with fierce competition. And with the geopolitical environment and complex economic environment, we are in phase of the need to transform ourselves. And with the competition around the world, we have to address the shortcomings in Hong Kong. We have to enhance our competitiveness. We should not rely on unilateral tax, so I speak in support of the bill.
Dr. Starry Lee. I speak in support of the Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024. In 2021, we've seen the OECD announce a BEPS 2.0 framework to tackle the base erosion and profit-sharing BEPS risks arising from the digitalization of the economy. It is for the tax planning of large groups, and they have to submit at least 15% in minimum top-up tax. And let me first declare an interest. I serve a company that may be subject to the relevant taxes. We practice the territorial principle of taxation. To implement these rules, it may hurt the competitive advantage of Hong Kong, but if we do not comply with the OECD rules, we will face other challenges. We may see other jurisdictions imposing taxes on us, causing us to lose out on the imposition of taxes. We may also be included in a blacklist that will hurt our status as an international financial center. Having considered these relevant factors, I support the government's introduction of such bill. We do see different opinions. We have seen the US or other major economies that have yet to implement the relevant rules. And with Hong Kong implementing the relevant provisions, it is bound to affect Hong Kong in some way. We will have a higher tax burden for companies, unfortunately. But I understand that professional services sectors and companies in general understand and will implement the relevant rules. I hope that the government will consider the company's needs. There will be a higher burden on them because the companies have to do calculations and there may be some confusion what is included or not in the calculations. I hope that in future there will be clear guidance issued to companies. I've also heard companies say if in the first few years the companies made some mistakes and the companies are assessed with higher taxes than expected, I hope that the companies will not be fined, because we want to adopt an education approach before we punish them. And inevitably, the companies would incur higher compliance costs because they need to engage consultants or they may need some advice. In the end, it will result in a bigger burden for companies. Companies are going to be profitable in some way in order to stay in business, but they do face some uncertainties with the compliance costs. So I hope that more support can be given to them. I know that the government has heeded feedback of stakeholders and the administration has now proposed 100 odd amendments. It is such a high number that is almost never seen before. The amendments include some set-off mechanism that would allow for tax credits of some other jurisdictional top-up taxes, extending time limits, as well as amending the offenses in respect of offenses by directors and officers of the entities and service providers, etc. This shows the government has incorporated feedback of various stakeholders. I understand that professionals and companies are still, to some degree, confused about the provisions. Well, the director or the commissioner for Inland Revenue is not here, but I would like my views conveyed to the commissioner. In future, when assets are sold, will they be taxed? We do know most companies' accounts are on a cost basis, and it is said in future they would need to convert costs to the evaluated amount, and when the asset is sold, the profit realized will not be included in the calculation of the 15% tax. Can the secretary confirm if that is the case? For those who have an accounting period end of December, it cannot be helped, but for those who have accounting periods and in March, you can still save them. So once you have an answer, please issue clear administrative guidance to companies so that the companies can handle their accounts accordingly. Lastly, on competitiveness, low tax rates have all along been attractive to companies as an advantage of Hong Kong. I know that the government has been working hard to troll for enterprises and talent. But we have to face the fact that we are losing the competitive edge in our tax system. And companies consider multiple factors, including this, when they see whether they are to set up operations. I know that Invest Hong Kong and other departments are working hard to troll for enterprises and talent, but they say themselves that Singapore may be more competitive, especially in terms of the tax system. Mr. Chen Chenying talked about we have multiple tax bills handled this year, but we are somewhat lagging behind other jurisdictions. I hope that the commissioner and the secretary should conduct more studies into our taxation system. A good tax system is very attractive to companies, and if we lose that competitive edge, it is not desirable, especially for some R&D enterprises. We do have super tax concessions, but the trade actually wants some tax credits. You may think that if we do not charge for taxes, there will be less tax revenue, but I think we can perhaps have a middle ground by imposing a cap. I hope that you can be more innovative and that you should act quickly. We need to keep abreast with the times. We also need to look at the competition. We recently amended taxation law in relation to aircraft leasing, but Ireland is still more competitive than us. We have yet to realize our vision of surpassing Ireland. I hope that the Inland Revenue Department will conduct studies into developments of BAPS 2.0 framework in various jurisdictions so that Hong Kong can continue to be attractive to enterprises. I so submit speaking in support of the bill. Mr. Martin Liao. President, I first would like to declare an interest. I am a board member of an M&E group. We have many enterprises that have had income in sources such as IP rights and other foreign source income, and they would choose tax havens to have their headquarters set up there so that it will be the case that they will enjoy low profits tax. We have seen the digitalization of economy bring about various opportunities as well as challenges in terms of taxation. When faced with this situation, the OECD in November 2021 announced the BAPS framework. And specifically, BAPS 2.0, for Pillar 2, it specified that M&E groups with annual consolidated revenue of 750 million euros or above, a global minimum tax of 15% will be imposed. Right now, we have 140 odd jurisdictions, including Hong Kong and mainland China, adopting the framework. We have UK, Switzerland, South Korea, and Vietnam, etc., that have already completed the implementation in legislation of the BAPS 2.0 framework. The Inland Revenue Amendment Minimum Tax for M&E Groups Bill 2024 is to implement the BEPS 2.0 framework, so that for the 4 past financial years, if an M&E group has an annual consolidated revenue of 750 million euros or above, a global minimum tax of 15% will be imposed in the form of Hong Kong minimum top-up tax. This will allow us to safeguard our taxing rights. I very much support the direction the government has taken. If the bill is passed, starting from 2027 to 28, it will bring to the government an additional revenue of about $15 billion. These are rough estimates according to the administration, but since the government is in a tight fiscal position, any additional revenue will help. Most of the bill is just a repetition of the BEPS 2.0 framework. So what's more important is implementation, and this is the focus of the deliberations of the Bills Committee. I welcome the government's incorporation of feedback and introducing relevant CSAs, including reducing the record-keeping period from 12 years to 9 years, and also extending the time limit for submitting globe information returns from 30 days to at least 60 days. The government will also offer flexibility for the deadline in the first year of submitting returns. The deadline will be extended to 15 months. For M&E groups with annual consolidated revenue of 750 million or above euros and headquartered in Hong Kong, there are approximately 200 to 300 of them. We have in total those with operations in Hong Kong over 2,000 of them. I hope that the government will issue guidelines and provide support to these companies if necessary. Taxation system is one of the 10 important factors of consideration for companies to see whether they are to set up operations in a location. I do understand why the business sector may be concerned that the bill's provisions may hurt the competitiveness of Hong Kong. But let me say this, the target group is only M&E groups for 2 of the past 4 years have an annual consolidated revenue of 750 million euros or above. We have in Hong Kong 98% of the companies being SMEs. They will not be affected. The global minimum tax involved will mostly target R&D enterprises, and not a lot of them are in Hong Kong because of the lower tax rates. If they are entitled to other forms of government support, the concessions provided to them will still be available under the OECD framework. Basically, as we see other economies implementing BEPS 2.0 framework, we will be somewhat able to maintain our competitive edge because we are all equals. Under one country, two systems and our practice of the common law, we are with our advantages. We have now 9,960 foreign companies with operations in Hong Kong. We have seen this being a record high. It shows Hong Kong is attractive to foreign enterprises. With the taxation system being somewhat equal, we will have a competitive edge, especially with support of our country and integration into the Bay Area. We can be a gateway for foreign enterprises into China, as well as a springboard for mainland companies to go global. But we are at a critical juncture of transformation. We need to continue to review our corporate structure and enhance the competitiveness of Hong Kong. President, I speak in support of the bill and the amendments. I so submit.
Mr. Tang Fei. Deputy President, I speak in support of the Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024. I'm a member of the Bills Committee, and therefore I support the bill. I support all the CSAs as well. The SAR government, based on the global tax reform, wrote out this amendment. This is a proposal promoted by the OECD to tackle base erosion and profit shifting. Under the BEPS 2.0 framework, we see a new round of tax reform, and therefore, in the SAR, we'll have to enact legislations as well. I, at the Bills Committee, asked whether this is a compulsory responsibility or obligation on our part. While it may not be the case, Hong Kong, as an advanced economy, should follow the major trend to reform our tax regime. So I think this bill deserves our support. I think through this amendment bill, we can reinforce our status as an international financial center. This bill is meaningful. This is because it can dispel the international community's concerns about Hong Kong. There is a very high requirement in terms of the tax regimes around the world. The EU, concerning jurisdictions that impose harmful taxes, they are listed into the so-called grey list or black list. Hong Kong was once listed on one of the list of cities that deserve the attention of the EU. And this brings potential risks to our business environment. Through this bill, we can be in line with the latest international standards as well as the major global trend. This targets MNE groups by imposing a 15% tax. To advanced economies as well as the EU, we are sending a very strong message that we are following the global trend, and this helps dispel concerns from the international community over Hong Kong. We can reinforce our status as an international financial center. Also, this bill can help enhance our revenue. This can help mitigate the fiscal deficit. According to the government's initial estimate, by rolling out this tax regime every year, we will see $150 million of additional tax revenue. With the current fiscal deficit, it's great that we can have this additional revenue. However, this bill is not to tackle our fiscal deficit. We have to be clear on this. Also, this tax reform targets at multinational enterprise groups. It will not affect SMEs. I'm not going to repeat the points mentioned by the other members. For enterprises with about 6 billion Hong Kong dollars of consolidated profits every year, they will meet the threshold. For the 98% of SMEs in Hong Kong, they will not be adversely impacted by the bill. We have been adhering to a low-end tax regime, so this proposal is not going to affect most of the enterprises in Hong Kong. Now, this is the way I see this bill. this bill compared to the bill moved or passed at the end of last year about the headquarters economy as well as redomiciliation. I think these three bills can be looked at together. We can make use of these bills. Some members just now said that this tax proposal will require ME groups to adapt to a rather more complicated tax regime. We can no longer resort to a simple and low tax regime to attract multinational groups. Well, our secretary, Mr. He, went to Canada to promote our tax policies. I think to attract foreign enterprises, we should no longer rely on our low tax regime. Also, for foreign companies or multinational groups, it's a low tax regime their only consideration when they decide whether to redomicile their headquarters to Hong Kong. This is not the most important factor. Like the other members said, like in the Greater China region as well as in the GBA, our connectivity with them is crucial. We have to maintain our robust legal system. We have to make use of our advantages in terms of our business environment and legal system. This is the determining factor for ME groups when they decide whether to set up their headquarters or redomicile their operations to Hong Kong. So we have to consolidate and integrate the three policies and three amendment bills. In the long run, we will not see a weaker competitive advantage. Instead, we will be able to attract foreign companies and they will help inject impetus to our economy. Now, the bill passage is only the first step. We have to pay attention to a few things. For example, we need a clear set of guidelines. We have to offer support to multinational enterprise groups so that they can transition to this new tax framework. Also, we have to stay in close communication with international organizations, including the OECD, as well as the EU. We have to talk to the taxation authorities and tell them we are following the rules of the games, so we should no longer be listed on their gray list. We should also continue to monitor and assess the implementation of the new tax rules compared to that in other places around the world. I remember I raised this question at the Bills Committee. Say, for example, for some jurisdictions, they may be implementing this global minimum tax rate by enacting legislation, but they may, through different means, compensate or make up for multinational enterprise groups in order to attract them to relocate their operations to these low tax jurisdictions. Well, we have to be careful with this. While we stringently implement the rules, others may not, and we may lose out to them. We have to make use of this bill, the bill on redomiciliation, as well as the bill on headquarter economy. If we can make use of these bills effectively, we'll be able to attract overseas as well as mainland enterprises and capital to Hong Kong. Then we can make our business environment more vibrant. I so submit I speak in support of this bill as well as all the proposed CSAs. Mr. Robert Lee. Thank you, Deputy President. I support the Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024. The bill seeks to implement the framework proposed by the OECD. It will impose a 15% of global minimum tax rate on MNE groups that meet the threshold. It is also to introduce the HKMTT. I'd like to raise the following concerns. According to the bill, if MNE groups during 2 out of the 4 fiscal years preceding the current fiscal year meet the threshold of 750 million euros of consolidated profit, they will be asked to pay a 15% of global minimum tax. The bill helps protect the taxing rights of Hong Kong. In order for us not to lose out to other jurisdictions. The government expects that the top-up tax will bring in an additional of $15 billion of additional tax revenue to the government every year, starting from year 2027 and 28. I raised a couple of concerns to the administration. Some enterprises have accumulated assets for years, and once there are transactions, the account books may show that there is huge profit. This may cause huge tax burden on those enterprises, and I asked how we can offer support to these enterprises. The administration said that there are two ways to reduce the chances for these enterprises to lower their top-up tax. They may even not have to pay the top-up tax. There are provisions under the OECD rules that some enterprises can make use of the carrying value of their assets to lower the top-up tax. Also, companies, if they hold over 10% of the shares, they will not be counted as part of the top-up tax chargeable. The industry may not be familiar with these details. I hope that after the passage of the bill, the administration can enhance the explanatory work. So to address questions about compliance burden and technical support for enterprises. Also at the Bills Committee, I expressed concerns about whether the top-up tax would affect the competitiveness of Hong Kong. The administration explained that this set of rules have been implemented in different places around the world, and the competitiveness of Hong Kong will not be undermined. Even with the global minimum tax, we still adhere to a rather low and simple tax rate because there are no sales tax or tax on capital gains. The main point is how we can provide convenience to enterprises by, for example, streamlining the procedures or reducing the compliance costs. We should make use of the $15 billion of additional tax revenue per annum to enhance our competitiveness. For example, in Singapore, the government provides tax concessions to enterprises, which include tax concessions concerning profits generated by IP and so on. This bill will help create a level playing field for Hong Kong, and it will also bring additional tax revenue to the government. We have to continue to maintain our competitive edges. For example, this March, after the capital entrant investment scheme, we see that there is an increase in terms of applications by 4 times. We should maintain our competitive edges so that Hong Kong will remain as the premium destination for global investors that will help reinforce our status as an international financial center. I so submit. Thank you.
Mr. Chan Kin Paul, thank you. Deputy President, I speak in support of the Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024. To tackle base erosion and profit shifting risk arising from digitization of the economy, the government has tabled into the Council this bill to implement the framework proposed by the OECD targeting multinational enterprise groups with annual consolidated revenue of $750 million. They will be paying a minimum tax of 15%, and that's the global minimum tax rate. And that Hong Kong minimum top-up tax will also be introduced since the establishment of the framework in 2011. Over 130 jurisdictions, including Hong Kong, have adopted the two-pillar solution under the framework. To consolidate our status as an international financial center, we must pass this amendment bill to enhance confidence among international investors. The bill can also help refine our tax base and bring additional revenue to the public coffers. We have a territorial sourced taxation principle. For foreign sourced income, they enjoy exemption. We do not charge dividends tax or capital gains tax. Now, the bill will protect our taxing right, such that we will be able to charge a Hong Kong minimum top-up tax for MNEs earning meeting the threshold, and it is estimated that the 15 billion Hong Kong dollars of additional revenue will be brought to our public coffers. This can alleviate the financial pressure on the government. Now, if the government does not enact legislation in a timely manner, the taxing rights will be passed to other jurisdictions with the introduction of the global minimum tax rate. Now, Hong Kong practices a simple and low tax regime. We have good legal system. We also have good infrastructure and talents. Many multinational enterprise groups have set up presence in Hong Kong. There may be concern that the global minimum tax will hamper our low tax regime, but in fact, this is a misconception. After adopting BEPS 2.0 by 130 jurisdictions, the other low tax or zero tax jurisdictions will no longer be able to use the low tax advantage to attract businesses to set up presence there. And this will mean that Hong Kong enjoys even a greater advantage. As we have one country, two systems, we can also bolster our status as an international financial center in order to attract MNE groups to come to Hong Kong. So we need to be proactive in protecting our taxing rights and also stop MNE groups from practicing tax avoidance in tax havens. Well, we have unique advantages. We have a very good business environment, and we must continue to do our best in the face of competition. That means we should continue to review various business practices and compliance requirements. The government should also enhance efficiency in their responses so as to bolster our status as an international financial center. Mr. Rock Chen. Deputy President, I speak in support of the Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024. The bill is drawn up on the basis of BEPS 2.0, developed by the Organization for Economic Cooperation and Development, OECD, which provides a minimum tax rate of 15% to multinational enterprise groups, MNE groups around the world. The bill also introduces a Hong Kong minimum top-up tax arrangement. Over 140 jurisdictions around the world have accepted the BEPS framework so as to tackle base erosion and profit shifting risks arising from digitalization of economy. Now, the Hong Kong MTT and the global minimum tax rate arrangements will be put in place, and this shows our accountability as an international financial center. And we also will work with the international community in enhancing tax transparency and combating tax evasion. We will introduce the globe model rules, and through this arrangement, we can ensure fair treatment and a level playing field. According to BEPS 2.0, large M&E groups with annual consolidated revenue of 750 million euro or above in at least two of the 4 fiscal years preceding the current fiscal year must pay a minimum effective tax rate of 15% on their profits. Now, the bill also introduces 4 schedules on top of the new arrangements so as to incorporate the globe model rules announced by the OECD, and also introduce relevant provisions on global minimum tax rate, the Hong Kong minimum top-up tax, as well as the commentaries administrative guidelines to be promulgated by the OECD so as to ensure that MNE groups with presence in Hong Kong will at least pay a tax rate of 15% following the OECD requirements. Now, it's worthy of our attention that investment entities and insurance investment entities are exempted, having regard to safeguarding the competitiveness of the relevant industries and also to avoid double taxation. Now, for other MNE groups within the BEPS framework, as long as they have presence in the jurisdictions covered, they are still required to pay the top-up tax. Provisions are put in place for the calculation of the minimum top-up tax, and also to make sure that the latest administrative guides promulgated by the OECD will be adopted. For Hong Kong member constituents entities, sufficient flexibility will be provided for the submission of the Globe information return, and there are also new offences made out in various provisions against non-compliance. There is also time limit for prosecution as well as other compliance requirements, so as to reduce the incentive for MNE groups in shifting profit to other low tax or zero tax jurisdictions in order to avoid their tax responsibility, and also to make the global tax environment fair. This will also bring additional revenue to the public coffers. According to BEPS 2.0's globe rules, now if the MNE group Hong Kong entity in Hong Kong pays an effective tax rate of less than 15%, then other jurisdictions covered by the BEPS framework are entitled to charge a top-up tax. So introducing the Hong Kong minimum top-up tax will allow Hong Kong to have priority over other jurisdictions in demanding top-up tax, so that the effective tax rate payable by that MNE group will amount to 15%. This can safeguard our taxing rights and avoid allowing other jurisdictions to impose minimum tax on the MNEs groups in question. Now, it is estimated that with the introduction of the new policy, an additional $15 billion of revenue will be received. This will help generate revenue for Hong Kong. Now, about the impact of the Hong Kong MTT on our competitiveness and an advantage, and whether Hong Kong will remain attractive to investors, I fully agree with the administration that the bill seeks to implement the international taxation standards. We're not targeting offshore income or capital gains. We do not have capital gains tax, and we're not introducing new forms of tax. We don't change the profit tax mechanism. So I don't think this bill will have significant implications on our tax advantages. Along with 140 jurisdictions around the world, Hong Kong will implement this framework and the global minimum tax rate. For other low tax or zero tax jurisdictions, they will no longer be able to rely on the low tax advantage to attract enterprises to set a presence there. So a level playing field is provided. At the same time, we have various advantages. We have a low and simple tax regime. We also enjoy the advantage of one country, two systems. We have good infrastructure. We are a talent hub, and we are also an international financial center. All these advantages will help boost our competitiveness. The bill seeks to align our tax regime with international standards so as to enhance compliance and support a level playing field. I think the Hong Kong SL government should continue to monitor the latest developments in the global arena and make necessary policy adjustments so as to keep our edge. I so submit I support the bill.
Mr. Edmund Wong. Thank you, Deputy President. This bill will impose a global minimum tax of 15% on M&E groups with annual consolidated revenue of 750 million euros or above. 2 years ago, Hong Kong has implemented the FSIE and then thereafter implement the OECD BEPS 2.0 framework. This is an important step towards the direction. After legislating for the framework, it will prevent Hong Kong from being included in the blacklist of the OECD. It will also help Hong Kong develop into a finance center, and we can construct with the 140 odd jurisdictions in the OECD in tax cooperation. This is a taxation bill. Some would often say two things are inevitable. One, death. Two, paying taxes. And Hong Kong would have most people paying taxes, but we have also known that there are tax havens that have ridiculously low tax rates or even zero tax rates to attract enterprises. The best thing about implementing the global minimum tax in Hong Kong is not just about the additional tax revenue. It is about how we can make tax havens lose their edge. And we can then demonstrate our advantages apart from the tax system. We have great inherent advantages. We have our talents, we have various very efficient systems. We have a few weeks ago passed the redomiciliation regime bill so that companies can redomicile to Hong Kong without going into liquidation in other jurisdictions. Last Friday, the ordinance commenced, and we have heard some good news already. We have large insurance companies expressing their intention to redomicile to Hong Kong. This will tie in with our implementation of BEPS 2.0 framework to attract enterprises to come to Hong Kong or expand their operations in Hong Kong. This will help Hong Kong develop into a commerce hub. With the imposition of the minimum top-up tax, it does not change the fact that Hong Kong still has a simple and low tax rate system, but it may still increase the compliance costs for companies. In order to comply with the BEPS 2.0 framework, the government has put in place some safe harbors, including the transitional country-by-country reporting, as well as QD-MTT safe harbor and 2 other safe harbors to reduce the compliance costs of companies. As the Deputy Chairman of the Bills Committee, as well as a representative of the accountancy sector, I paid close attention to the developments of the bill. I have got feedback from the accountancy sector and raised a number of suggestions, and I am glad that the government is introducing amendments to respond to my feedback, including setting a fixed limit as time limit, as well as shortening the record keeping period from 12 years to 9 years, to extend the time limit for top-up tax assessment, and extending the time limit for amendments to be made. And it has also made clarifications as to the provisions in the IRO. For example, the reimbursement for top-up tax will not be included in the calculations of the profits or loss of the paying entity or receiving entity of M&E enterprises. These would offer flexibility, and that would also allow for more tax credits to benefit enterprises for jurisdictional top-up tax. The government also asks the INSCO M&E groups to file profits tax return electronically. It is mandatory. As an accountant, I have raised some technical issues during the deliberations of the Bills Committee. And the Bills Committee, by nature, wouldn't have discussions that will be too technical. But I did get responses from the government, and I also had the IRD pledge some of the issues, saying that they would provide solutions. I thank the government for taking such a proactive approach. The bill demonstrates our vision to develop into an international financial center and our responsibility to make contributions to have a fairer tax cooperation network. In future, tax havens simply attracting enterprises by having low or zero tax rates will no longer have that edge. It is more important to have simple and low and stable tax and legal systems, so that we will have an attractive business environment for businesses. And Hong Kong is definitely advantageous in such areas. We have all along had great tax certainty. This is attractive to many M&E groups to set up their headquarters or regional headquarters in Hong Kong. Upon passage of the bill, we should have the bill's provisions tie in with the redomiciliation regime, as well as enhance collaboration with departments that will troll for enterprises and talent. In the end, we want to attract more enterprises to come to Hong Kong, to headquarters in Hong Kong, and make contributions to the local economy. I so submit speaking in support of the bill. Mr. Dennis Leung. Deputy President, I was a member of the Bills Committee. I will speak on behalf of the FTU. I speak in support of the Inland Revenue Amendment Minimum Tax for M&E Groups Bill 2024. We have seen BAP's risks arising from the digitalization of the economy. The OECD has therefore announced a two-pillar solution that is often called the BAPS 2.0 framework. In July 2021, Hong Kong joined more than 130 jurisdictions in accepting this two-pillar solution. Under Pillar 2 of the BAPS 2.0 package, a global minimum tax of 15% will be imposed on M&E groups with annual consolidated revenue of 750 million euros or above. So this is an effective tax rate. We have seen many different economies, including Australia, Canada, Singapore, and the UK, having legislated or are currently legislating for the implementation of the framework. To implement the framework in 2025, this year or next year. The provisions are very clear. One is to implement the responsibility in addressing BAP's risks. As a key player in the global economy, we have all along been working hard to avoid or prevent tax evasion. We have been trying to provide tax certainty and implement the responsibility. This shows our commitment to developing into an international financial center. For those who have been charged less than 15% globally, we will charge the M&E groups with a Hong Kong minimum top of tax. And it is expected from 2027 to 28 onwards, an additional tax revenue of about $15 billion per year will be brought to the government. If we do not do this, this taxing right will be lost to other jurisdictions, and the tax revenue will essentially be transferred to other jurisdictions. We do see the urgency in legislating for the implementation of the framework. The additional tax revenue will help our difficult fiscal position. We will see the other 130 odd jurisdictions legislating for the implementation of the framework. It may not be the case that all tax revenue will be transferred to Hong Kong, but this is our responsibility, and we have also implemented reforms in company law to tie in with the implementation of the framework. Deputy President, the FTU is most concerned about the rights of grassroots workers and citizens in general. We want to make sure that it is stressed that only M&E groups will be affected. The threshold is an annual consolidated revenue of 750 million euros or above. This is a high amount. For most local companies, especially SMEs, who account for 98% of the total number of companies in Hong Kong, they will not be affected. Hong Kong continues to have a simple and low tax system. It will be attractive to enterprises. The provisions also will help provide tax certainty. The government will also provide support if necessary. The government has also introduced some safe harbor provisions. I hope that companies will reach out to the IRD to get more information should they wish. Deputy President, this is a new trend to implement minimum tax. If we do not legislate for the implementation of the framework, we will just lose our taxing rights, and it does not help Hong Kong in any way, because the companies would have to pay in other jurisdictions the relevant taxes. The profits tax rate in Hong Kong is 16.5%. It is relatively low compared to other jurisdictions. We also have a low and transparent tax regime. The bill's provision will provide more tax certainty that will facilitate the long-term planning of companies, and complementary with the company law reforms. I believe the bill's provisions will actually be very attractive to enterprises. Extensive consultations have been conducted. The panel on financial affairs was also consulted. Most stakeholders agree that the minimum tax regime should be implemented in Hong Kong. In the uncertain external environment, Hong Kong's advantages of having certainties and efficient markets will attract more enterprises to come to Hong Kong. This is an inevitable path we must go on. And we have seen recently the IOM headquarters being set up in Hong Kong. This demonstrates our development into a financial center. Again, on behalf of the 7 FTU members, I so submit speaking in support of the relevant bill.
Dr. So Chun-Wing, Deputy President. I speak in support of the Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024. We are going to implement this global minimum tax in Hong Kong. As proposed by the OECD, all participating jurisdictions will impose a global minimum tax of 15% on M&E groups with an annual consolidated revenue of $750 million. In the past, some M&E groups have their company set up in low-tax jurisdictions to evade tax. And under this proposed tax framework, M&E groups may consider relocating their businesses to places with better business environment. The SAR government is forward-looking. Before introducing this bill, the government had already introduced the company's redomiciliation regime. The bill on companies' redomiciliation, as well as this proposed tax reform, will be attractive to enterprises. Since the implementation of the redomiciliation regime, some multinational groups have already announced that they would relocate their enterprises or companies to Hong Kong. There have been economic requirements imposed by different countries, and this increased the compliance costs for enterprises. In Hong Kong, we adhere to a simple and low tax regime. We have the support of our motherland, and we are close to this huge market in China. Therefore, it is very appealing for enterprises, and they may redomicile to Hong Kong. This will also increase demand for professional services and investment here. This tax proposal is to align ourselves with the international standards. And we can take this opportunity to create a win-win situation for both Hong Kong and enterprises. This proposal can prevent enterprises from evading taxes by setting up operations in low-tax or zero-tax jurisdictions. According to the proposed regime, Hong Kong will have to impose top-up tax of not more than 15% on M&E groups to cover the difference. Otherwise, other jurisdictions will have the right to charge the differences in tax to these enterprises. This can safeguard our taxing rights, and this can ensure that we won't lose out to the others. Starting from year 2027 and 28, we will see an additional tax revenue of $15 billion per year. The profits tax in Hong Kong is 16.5%, but according to the government, most enterprises will pay a profit tax lower than 16.5%. This is because a lot of items are not chargeable in Hong Kong, including offshore profits as well as profit generated from dividends. Legislation is just the first step to ensure smooth implementation of the policy and to ensure maximum profit. Or for Hong Kong, I think we have to do the following. We have to enhance support for M&E groups. While a group has been set up to offer technical support to enterprises, the way of calculating the tax may be complicated, and this could be a challenge for enterprises. I think the government should further streamline the tax filing procedures to help enterprises transition to the new rules. For example, there should be clear taxation scope for enterprises adopting the financial report standards. Also, there should be greater collaboration between the mainland and the international systems. This tax regime is implemented in different jurisdictions in order to ensure that there won't be double taxation. There should be a dispute resolution mechanism to promote information exchange between jurisdictions. There should be an assessment mechanism to ensure that our competitiveness will not be undermined because of this tax reform. Under this tax framework, only very few enterprises will have to pay the top-up tax, but we have to monitor the compliance cost of enterprises so that our low tax regime's advantages will not be undermined. The government should regularly talk to business associations to exchange information with them and to learn about the latest development of the market. Also, we have to enhance the appeal of our company's redomiciliation regime. We have to provide more convenience for enterprises. We can achieve this by achieving greater synergies with the Greater Bay Area. There should be better interfacing proposals to help M&E groups get into the mainland market. Thank you. I so submit. Mr. Yim Kong. Thank you, Deputy President. I speak in support of the Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024. This amendment is to help Hong Kong fulfill the obligations with the trend of digital economy. Hong Kong has to prevent risks associated with base erosion and profit shifting. According to the OECD, every year, because of base erosion and profit shifting, there is a loss of tax revenue of hundreds of billions of US dollars. This threatens the tax revenue of different jurisdictions. In July 2021, Hong Kong, together with 130 jurisdictions, implemented the two-pillar proposal, that's BEPS 2.0. The proposal clearly requires M&E groups with annual consolidated revenue of 750 million euros to pay a global minimum tax of 15% to their jurisdictions. This is to ensure fairness, as well as to prevent vicious competitions. If Hong Kong does not jump on the bandwagon by implementing this tax reform, the following will happen. Other jurisdictions will levy tax on behalf of Hong Kong on M&E groups, and we will lose out to the others. Also, our international reputation may be undermined. And this may affect people's confidence in the rule of law environment of Hong Kong. This can also prevent double taxation for enterprises. This can also ensure that their compliance costs will not be too high. Hong Kong should safeguard its taxing rights. According to the FSTB, starting from 2027-28, by implementing the global minimum tax, we can have an additional tax revenue of $15 billion per year. This can help strengthen our public finances. At the same time, we can send out the message to the international community that we support the tax reform as we strive to achieve fairness in competition. We may face the following challenges, however. ME groups or their constituent entities in Hong Kong, they'll have to comply with the new computing model as well as tax filing system. This may increase their compliance costs. Also, to ensure smooth implementation of the new tax regime, any double taxation may cause controversies. We have to, at the same time, continue to promote the advantages under our low-end tax regime to maintain our competitiveness. In response to these potential challenges, the government has rolled out the following measures. For example, a dedicated group is set up under the IRD to address inquiries of ME groups. A guideline will also be published. This deserves our support. I hope the government will do the following. First, I hope it will provide training for relevant enterprises to reduce their compliance burden. Secondly, it should take part proactively in international mediation so that our standards will be widely recognized. Thirdly, we should enhance our strength under the existing low tax regime. We should leverage our advantages in our financing sector, infrastructure, as well as our talent to increase our competitiveness. This amendment bill is crucial. This brings us in line with the international tax standards. This new proposal will bring in tax revenue for the government, and at the same time, it can improve our business environment. I hope that we can seize the opportunities and continue to be the connector in the world. I so submit. Thank you.
Does any other member wish to speak? If not, I now call upon the Secretary for Financial Services and the Treasury to reply. Then the debate will come to a close. Secretary. Deputy President, I thank Chairman of the Bills Committee on Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024, Mr. Ronald Chan, Deputy Chair Mr. Edmund Wong, and also 12 members of the Bills Committee for their hard work in scrutinizing the bill. I also thank 11 members who have just spoken on the bill and offered their valuable insights. To tackle tax evasion risks arising from digitalization of the economy, the Organization for Economic Cooperation and Development, OECD, introduced the BEPS 2.0 Base Erosion and Profit Shifting 2.0 package in 2021. So far, over 140 jurisdictions, including the mainland and Hong Kong, have adopted this package. The bill aims to implement the global minimum tax and Hong Kong minimum top-up tax in Hong Kong from the 1st of January 2025 in accordance with BEPS 2.0. Specifically, Multinational enterprise groups, M&E groups, with annual consolidated revenue of 750 million euros or above in at least 2 of the 4 fiscal years immediately preceding the current fiscal year must pay a minimum effective tax rate of 15% on profits generated in each jurisdiction where they operate. This measure reduces incentives for M&E groups to shift profits to low-tax or no-tax jurisdictions to minimize their tax liabilities and prevent harmful tax competition among jurisdictions, lowering corporate tax rates in order to attract capital and investment. The implementation of the Hong Kong minimum top-up tax not only fulfills Hong Kong's international obligations to combat cross-border tax evasion, but also ensures that the Hong Kong SL government has priority to collect the top-up tax from MME group entities with an effective tax rate below 15% in Hong Kong, bringing their effective tax rate up to 15%. Otherwise, such top-up tax could be collected by other jurisdictions implementing BEPS 2.0, where the M&E groups operate. Many jurisdictions, including EU member states, the UK, Singapore, Switzerland, have already implemented or will implement BEPS 2.0 in 2024 and 2025. M&E groups will inevitably need to pay the global minimum tax. If we do not legislate in time, we'll forfeit our taxing rights. While the overall tax burden on M&E groups under BEPS 2.0 will not be reduced, we expect the implementation to generate additional tax revenue of about 15 billion Hong Kong dollars every year for our government starting 2027 and 28. Many members and stakeholders are concerned about whether implementing the global minimum tax and the Hong Kong MTT would affect Hong Kong's competitiveness as an international financial and business center. I want to emphasize that the new mechanism will not only maintain but strengthen Hong Kong's competitiveness as an ideal location for business. Under the global minimum tax regime, jurisdictions can no longer compete through lowering profits tax rate to attract business and investment, and tax havens will become significantly less attractive to these groups. We firmly believe that in a fairer global tax environment, Hong Kong's unique advantages will become more prominent, including a one country, two systems, global connectivity, first-class infrastructure, a mature financial market, and quality talent hub, as well as a place where the East meets the West. Further, the legislative amendments have been passed to provide an efficient and streamlined mechanism for redomiciliation of corporations to Hong Kong. This will provide a flexible pathway to attract M&E groups seeking to redomicile from low-tax or no-tax jurisdictions due to BEPS 2.0 implementation. I'd like to highlight a number of points in the bill. First, we will maintain a simple, clear, and low-tax regime in Hong Kong. The government has not introduced any new taxes in implementing the BEPS 2.0 requirements. Second, only M&E groups with annual consolidated revenue of 750 million euros or above will be covered. Individual taxpayers, local groups, SMEs will not be affected. Third, as the OECD periodically updates its BEPS 2.0 rules, commentaries, and administrative guidance, we propose empowering the Secretary for Financial Services and the Treasury to make subsidiary legislation to incorporate these changes into the Inland Revenue Ordinance so as to enable expeditious implementation of the requirements in Hong Kong. Fourth, the global minimum tax regime comprises two components, the Income Inclusion Rule, IIR, and the Undertaxed Profits Rule, UTPR. The former imposes top-up tax on the group's parent entity for its low-tax foreign constituent entities, while the latter serves as a backstop to ensure that the top-up tax is collected. We will implement the IIR first, having considered the stakeholders' views regarding the UTPR. After considering the MEG Group's operating circumstances in Hong Kong following the introduction of the Hong Kong MTT and the IIR, the Secretary for Financial Services and the Treasury will specify the commencement date. To reduce the compliance burden on MEG Groups in following the OECD requirement, we will continue to apply the existing mechanisms under the IRO where possible to minimize difficulties. In response to the Bills Committee and stakeholder feedback, we propose amendments to provide greater clarity in implementation and to facilitate the group's compliance. These measures include 1. Providing safe harbors through OECD to exempt MEG groups from the calculation of full top-up tax. 2. Setting appropriate and clear deadlines for record keeping and the return filing requirements based on stakeholders' feedback. 3. Adopting a sole or dominant purpose test instead of the originally proposed main purpose test as a general anti-avoidance rule to maintain consistency. 4. Specifying that qualified domestic minimum top-up tax payable in other jurisdictions can be used as tax credits under specific circumstances through bilateral or unilateral relief. 5. Treating top-up tax collected in Hong Kong as profits tax, which will allow tax administration mechanisms under the current IRO to apply to top-up tax. Where applicable, MEG groups can utilize Hong Kong's comprehensive double taxation agreements to address cross-border disputes. On top of that, the Inland Revenue Department has established a dedicated team to provide technical support and answer inquiries. They will also publish online guidance on frequently asked questions to help taxpayers understand the new mechanism and their tax obligations. Now, besides the above compliance-related amendments, we will propose additional amendments to incorporate the OECD's latest administrative guidance after the Bill's Gazette and to refine the drafting of the bill. I will elaborate on this during the committee stage. In taking forward the present legislative exercise, the government conducted extensive public consultation and have maintained close communication with various stakeholders, including chambers of commerce, professional bodies, and also tax professionals, MEG groups. We had multiple exchanges. We've also briefed relevant government agencies, including the ETOs, Invest Hong Kong, the Office for Attracting Strategic Enterprises, to facilitate their timely explanation to international investors about Hong Kong's competitive advantages and that they will not be affected by the global minimum tax or the Hong Kong MTT. President, the bill strikes a careful balance between fulfilling international tax obligations, protecting Hong Kong's taxing rights, and facilitating taxpayers and investors. In finalizing the bill's provisions and amendments, we have thoroughly considered and responded to stakeholders' concerns. I ask members to support the passage of the bill and the amendments to be proposed so as to enable Hong Kong to implement the global minimum tax in the Hong Kong MTT this year and capitalize on the opportunities through international tax reform. So submit. And I put the question to you that the Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups Bill 2024 be read the second time. Will those in favor please raise your hands? Those against, please raise your hands. I think the question is agreed by a majority of members present. I declare the motion passed. Inland Revenue Amendment Minimum Tax for Multinational Enterprise Groups 2024. This council now becomes Committee of